Okay, before we head into the market outlook this week, update on the hat sales. Our target was 200. We got to 158. I said if we got to 200, I would just up my donation, the total donation, the pass on to 25,000. We got to 148, 158, somewhere in there. But I'm going to pretend we got to 2, and I'm just going to bring it up to $25,000. So the proceeds from the hat sales, plus my contribution, plus the difference will get us up to $25,000. So they're going to get a $25,000 gift for Christmas. For the Applied series, if you're a subscriber to the Applied series, you'll notice that over the last 2.5 weeks, nothing new has been posted. That's because I still have responsibilities on the CFA side, and the CFA side. I'll say it right. Give me a break. I still have responsibilities there, and December 15th was the release for the exams. So level 3 needed some changes in some of the questions and needed some new questions for the AM side. So for the last 2.5 weeks, I have been doing that. That is done now. So here is what's going to happen over the next couple of weeks. In the bottom-up analysis, I'm almost done DR Horton, the home builders, which is a sort of a larger look at the home builders, but a specific focus on DR Horton. For the applied macro and top down, we have this section here called sector studies, where you determine what sector you want to be on based on where you are in the business cycle. Another way of looking at investing is what factor exposures do you want based on where you are in the business cycle. So factor investing is very top down. Rather than saying I want to be in consumer staples or a consumer discretionary, you might say I want to be in quality, I want to be in fundamental momentum. What factor exposure do you want, and how do we determine what factor exposures a particular stock has? So that's very top down. So we'll do a factor allocation analysis for the top down. The next reading for technical analysis, the next few will start showing up as well. I still want to get the whole level 1 for the CMT done in there. I don't have anything really to do till mid-March. So from now to mid-March, it's just going to be additions to these. You'll start to see some things show up in applied futures and options on futures, because we have talked about enough things in some other sections that I can start putting some futures contracts in there, especially interest rate futures contracts, Fed fund futures. We should know more about how to trade them, more about the Treasury futures, and how we would use them and how we would apply those. So they'll start showing up in the applied futures. And for the ZN, ZT, the Treasury futures, there are options on those futures as well, and there are options on futures for the S&P 500. So you can move from options on SPY to options on ES, which are, each ES contract is like 500 SPY, so each option contract is like 5 contracts on the SPY. So that'll get interesting. So if you're wondering, how come we're not getting any more content? Well, for the last couple of weeks, it's been the level 3 exams. They are now open and released and ready to go for the February exam. So for the next 3 months, I'm back on the job. All right, we've got a lot to get through this week. And this week, we're going to be changing our focus. And the FOMC is going to be in the back seat for a while. We're not kicking them out of the car, but we're putting them in the back seat, and the economy is now in the front seat. So each week we're going to spend more time looking at what's going on in the real economy in terms of the level of activity, in terms of employment. We'll look at a couple other areas around the world, because now we're on recession watch. I think the damage that the Fed can do is pretty much over. Now we have to worry about growth. So that takes the front seat. And again, we're not kicking the Fed out of the car. We're just putting the Fed in the back seat because, well, give it a couple of months, the Fed might have to take the front seat again. But for now, I think we can put the Fed safely in the back seat. The next FOMC meeting is February 1st. That is 46 days away. Lots of time. We get the minutes halfway between last Wednesday and the 1st. PCE for November is in 5 days, and the next CPI report, which will cover the December period, is in 26 days. Let's look at our rates. Capital market rates have all decreased. And I think there's a story here. If we put the Fed in the back seat and put the economy in the front seat, this sort of is just a signal that kind of matches the rest of the economic data that we're going to look at. That the far end of the curve is not just reflecting the Fed doing a really good job and lowered inflation expectations, but is reflecting the economy possibly and even probably entering or has entered a recession, and nothing kills inflation like a recession. So the interest rate hikes, we think, push down inflation. But I think the better story that we're looking at now is the interest rate hikes have pushed the economy into recession territory, and the recession is curing inflation. So the Fed can take some credit for curing inflation by taking a lot of credit for curing economic growth. So their strategy of cutting down demand appears to be working, and we're going to look at quite a bit of economic data to see what that looks like. Money market rates, the 6-month and the 1 year are dropping, reflecting the possibility, the very real possibility that you've got a 25 basis point hike in February, and probably that would be about it, because the deterioration in the last 30 days of the economic data is accelerating. This is still a curiosity, 3.94 on a 1 month. Considering that the effective federal funds rate is 4.33%, 1 day SOFR is 4.3%, that you're getting a 30-day T-bill at 3.94. That has to reflect the inability of some participants to access the reverse repo facility, and they're moving to cash and taking what they can get. It could be end of year as well, that there is some end of year positioning on corporate balance sheet into cash equivalents to shore up their balance sheet for a year end. It could be that, and they're going to take what they can get because the location of their money being in safe securities with no duration, the location of their money might be more important than the return they're getting on their money. Have a look at the yield curve inversions here. The 2 to the 10 inverted 69 basis points. It was 76. So if you were doing the curve steepening trade, you picked up 7 basis points over the week. That is 165 days inverted now. The 3-month to the 10-year is down negative 83. It's down another 9 basis points. It's 53 days inverted, and that ties the deepest inversion so far at 83. The Fed balance sheet down 1.3 billion, but nothing really was maturing. These were all T-bills. So we're sitting at 8.072 trillion versus 8.074. ECB is joining the fight. Starting March in 2023, they're going to have 15 billion a month in runoff. Considering the size of their balance sheet, 15 billion a month, 180 billion over the course of the year, that's nothing. Compared, looking at the size of their balance sheet, it's really not. They're being very, very conservative on that. So I wouldn't be too concerned about this. But Lagarde came out really hawkish. She said the idea that we're going to stop anytime soon is ridiculous. There's no such thing as a pivot in our world, and expect more 50 basis point hikes to come. We are not done yet by a long shot. And, they've already got the balance sheet runoff planned for March. So this is going to, with these hikes, it's going to hurt demand over in the Eurozone as well. So, we can't just look at the U.S. as an isolated island because, the 40% of the S&P are global. We need a global marketplace that's growing. So this is negative for growth over in the European Union. Reverse repo facility down 20 billion from 2.146 trillion to 2.126 trillion, still over the 2 trillion mark. That's a greater than sign. And this was getting 4.3%. That is 1 day SOFR. SOFR is the secured overnight funding rate, and it is secured by treasuries, which is why I find the 3.94 odd, because you're getting less than the face value of the treasury, that's called the haircut, to secure the one-day rate, and it pays 4.03. That you're then getting 3.94 for 30 days. So this must represent a lot of demand that simply cannot access the reverse repo facility. February 1st, FOMC. Look at the probability, 75% on 25, 25% on 50. And I think as the economic data keeps coming out, I think we're going to see a higher increase on the 25 and a drop on the 50. This is the June distribution. And I think that from here down, I don't know that that's going to be in play by June. I think you'll see the probability shift downwards here when we look at where the Fed funds futures are and what they have done, considering what the new target rate is for the end of 2023 from the FOMC. It's in the opposite direction. Is the market openly fighting the Fed, or is the market saying, well, okay, Mr. Fed, you think that that's what's going on, but you know what? We're entering a recession. We're so very close to a recession if we haven't already entered one beginning December. If we haven't already entered one, we're going to be in one, which means the data will definitely tell you you don't need to do any of this. But as of right now, this is the June distribution. Most of the weight is on 4.5 to 4.75 and 4.75 to 5. I just put the upper end of the target range in here, but 4.75 to 5 is most of the weight. You do have some weight here, not insignificant, on the 5.25, but I think that we can draw a line here and say the recession will probably eliminate the need for that. And because it eliminates the need for that, this is consistent with that interpretation, that you would get some return from duration, because as yields drop, prices are increasing. So if you had duration exposure, if you had TLT exposure, for example, over the week, you were up over the week, even though it was kind of a rocky week, you were still up over the week. In fact, I think one of the most attractive places to be for the next year, and we'll talk about this a little later on, is a combination of a 1 year with the 20 to 30 year, probably more the 20 because you're getting a 371 on that. But TLT is the 20-year plus, so TLT gives you exposure to this. Plus, that's a nice rate on hanging out for 1 year. Because the equity markets next year, I don't know, are going to give you a 4.61% return. I think the 1 year treasury will beat the equity market for most of next year. Q3, Q4 of 2023, I don't know, but Q1, Q2, I think it's going to be more of what we're experiencing right now. All right, some interesting things on this screen here. Real rates, not that interesting. They've nudged up a little bit. What I find really interesting is look at these inflation break-evens. 2.14 on a 5-year. Huge drops right across the board. Now you can say, well, that would be consistent with the Fed talking tough. Inflation expectations are coming out of the long end of the curve. However, if that were the case, and we believe the Fed, and we believe the summary of economic projections, which is here, here's 2023, and look down here, federal funds rate, the September projection was 4.6. Now it's 5.1 for the end of 2023, which is 50 basis points higher. I would have expected, if this was consistent with believing that the Fed was doing a good job crushing inflation, I would have expected the Fed funds futures to look more like this. However, over the week, the Fed funds futures index has increased, meaning that the target rate within the index has decreased. Last week, the index was bottoming out at 95.04 to 95.05. May, June, July. It was pretty flat for those 3 months, implying a rate of 4.95 to 4.96. This week, it's bottoming out at May and June at 96.165, implying a rate of 4.815, which would, if we think about a policy range, would be in the middle of the policy range of 4.75 to 5. So it's actually, the rate has actually dropped from roughly about 4.955 to 4.815, 14 basis points. If we look at the pricing, here's January at the top of the screen, and here's February. And if you look at the difference between the index pricing, February drops by 31 basis points, which is suggesting a rate increase of 25 to 50 basis points, with more weight on the 25 because it's closer to the 25 than the 50, which we already saw that there was significantly more weight on the 25 basis points for probability for FOMC in February. Interesting thing is December. Okay, so again, let me draw your attention to the 5.1. The Fed said that last week. And Powell reiterated that in the press conference, saying, we are going higher. We're going to 5.1. We don't plan on cutting rates. Even Loretta Mester, in her interview after, said that we have the committee has no plans to cut rates anytime in 2023. And even with all of that, here's the December Fed funds futures. The index is at 95.575, which implies a rate of 4.425, or a target range in December of 4.25 to 4.5, pretty much where we are. So we are pricing in a February increase of roughly about 25 basis points, but then somewhere in the year there has to be a cut to get back to this target range. FOMC is saying no, we'll be at 5 to 5.25 because the 5.1 is right kind of in the middle of that range, and you're about 75 basis points lower in the market. That is more consistent with growth falling off than with the interest rate going higher. So the belief in the market right now is that, okay, the Fed is saying that they're going to that level, but the economy's probably not going to let them. Let's look at their summary of economic projections. Change in real GDP has dropped. The September projection was 0.2. They're up at 0.5, but it's the 2023 that's interesting. They were forecasting 1.2. And they're saying, no, 2023 is going to be 0.5. Still consistent with their soft landing scenario. But when we look at retail sales, we will look at leading economic indicators. We will look at PMIs. They're not talking about a soft landing. Unemployment rate is going to be a little bit higher, 4.6 by the end of 2023 instead of 4.4. We're sitting, I think, at 3.5 to 3.7 right now, so they're figuring we'll end the year right where we are, so almost a full percentage point increase in unemployment. PCE, their projections for it coming down are slower, so instead of 2.8 by the end of 2023, they're at 3.1. The big story is the Fed funds rate. Instead of 4.6, it's 5.1. End of 2024, they're at 4.1. The market seems to be almost there at the end of 2023. So if we are expecting a recession, what is going on in the Fed funds futures and what is going on with the 30-day is really understandable. And what's going on with the long end of the yield curve is that money is preparing for a recession. And if we're preparing for a recession, then the policy rate is going to have to reflect the fact that the environment that we're going to be in 1 quarter or 2 quarters is not going to allow the Fed to raise rates to where they think it's going that they need to go, because they're focused on fighting inflation without looking at the recession will fight inflation for them faster than their rate increases can fight inflation. Okay, we're going to look at CPI in a second, but before we get there, let's just review the notion of conditional heteroscedasticity. And for those who have not met this big long word before, what it means is non-constant variance. So I'll give you an example really quickly. Let's say that we have some data, and this is time, and this is some variable, whatever it happens to be. And we draw a regression line through all the data points, and we get something that looks like this. If we have good data, we should have our observations that look something like this, where the variance is constant. But inflation doesn't have that kind of behavior. inflation behaves like this. This would be non-constant variance. Is at low levels we have a low variance, but as the level increases we get higher and higher variance, so that we have non-constant variance, and the variance is conditional upon the level of x that we see. The higher the level of x, the higher the variance happens to be. Inflation shows this particular characteristic, which makes monetary policy at high levels of inflation. It increases the risk of monetary policy, the risk that they're going to make a mistake, either by going too far or not going far enough, because the data from month to month can have huge variability. But at low levels of inflation, the changes from month to month tend to be very low. You have low volatility, which means the risk of monetary policy are low. When I say the risk of making a mistake by reading too much into the data that you should not read in, because the random component at high levels of inflation, the random component is much higher. So you could have a period where you see no inflation 1 month, like we did in the summer, followed by 2 months of excessively high inflation, like we saw, followed by 2 months of, well, it looks like inflation is coming down, and we could see the next reading go all the way back up. That's the problem with inflation, is it has conditional heteroscedasticity. So the random component could make big changes from month to month, even though the trend is downward. So let me show you how that looks. Here's a bunch of normal distributions, and listen, I don't know if the normal distribution is the right distribution to use on this, but we're going to use a normal distribution. And let's say that this white line here is the forecast for inflation coming down. And because it's the forecast, it's what's called an expected value. An expected value is typically the center of the distribution. It is the most likely value that we expect to see. However, there is a range of values we would expect, because inflation is a random variable. And because it's random, it can take on any number within the range of its distribution. Well, let's say it comes in higher than expected. Well, that is well within, if we have a 95% confidence interval with a very wide distribution, that's well within the 95%. So that if we did some statistical test on that, we would say it is statistically not different than the expected value, but it did come in high. Because it came in high, the next distribution would still show a high level of variability. And it could come in higher than where the expectation was, but still be within the range. Then you could get something that happens like this, where in a month you get this huge drop down in inflation, but again, well within the range of what we're seeing. But now, because we're at a lower level, look what happens to the next distribution. Look what happens to the volatility of inflation. It will decrease as the level of inflation decreases, so that you get a smaller distribution. So we get a lower read here. The next distribution will be smaller. Here we are, closer to the expected value. The next month we're a little bit higher. Look what happens to the distribution the month after. It widens. So even though, follow this white line down. Look how nice and smooth the white line is. Let's say that this is the projection from the FOMC. That you could have observations that create this type of line where inflation falls and then looks like it increases again, and that's all within the 95% confidence intervals denoted by these distributions. Because you have really wide distributions at very high levels of inflation, you got much lower levels of distribution at lower levels of inflation. So let's just block out this area over here. Because of this high variability, we had, the reading for July was very low. August, September, October, November coming down. This is all within these wide distributions. They're all possible values within this wide distribution that represent randomness, but may not be capturing the trend very well when you look month to month to month, which is why the Fed says we would need to see a sustained period of inflation coming down. We would have to be absolutely convinced that it's coming down because this reading and this reading for October and November are well within these big distributions because you get something called conditional heteroscedasticity. So the idea that the Fed is going to cut rates just because they see inflation coming down is nonsense. They're not gonna do it until they're absolutely certain, because monetary policy risks are heightened here, and they've already said the risk of not going far enough are greater than the risks of going too far, which means don't expect a rate cut because inflation is coming down. But if inflation is coming down and economic activity is coming down, it's a recession that's doing it. The Fed would have a different stance if the economy is weakening. But don't expect a rate cut with an economy that's trudging along at 0% growth. Don't expect a rate cut for 2023. But if we start printing negative growth, if it's very clear that we're in a recession, if we start getting negative job growths in January, February, you start seeing the jobs report showing negative jobs, then we can start to get a cut in rates. Okay, this is the important table that we'll look at. There are, as I said many times when we look at these, it goes into detail. The tables below this one, this is table 1. The tables below go into a lot more detail into each category. So if you're into particular sectors, or you have stock in particular types of companies that have a particular product or service, it is worth going to those particular categories to see if your company is facing any downward pricing pressure. You're looking for negative signs. You don't want to see negative signs. You want to see negative signs if you want inflation to come down, but for your particular companies, you want them to continue to raise their prices as much as they can, right? Look at all items, 0.1. That is very benign inflation month over month, 0.1. If we move down to all items less food and energy, that's 0.2. That is very benign as well. But it's very mixed. You have outright deflation right now. This is commodities less food and energy. This is the goods sector. Negative 0.5 month over month, followed by negative 0.4 the month before. So I think the story there is very clear, right? You had the shutdown, services shut down. So what did everybody do? They said, well, instead of spending my money on a concert, let me go buy stuff. So there was this huge demand for goods, which drove inflation. Well, that's coming out of it now. But that inflation has found its way into wages, so it's found its way into the services component. Here's services less energy, services 0.4. Look at the trend here, 0.8, you had 0.8 down to 0.5, down to 0.4. The biggest component here is still shelter, right? Rent of primary residence, 0.8. Shelter is 0.6 on its own, 0.8, and owner's equivalent residence 0.7. That's going to take a while to run off, but in the November 30th speech that Powell gave, they did say that they were looking at new rents as part of that component. So I think they're perfectly willing to look past the year over year, the backwards looking increase in shelter prices, and they are looking at new rents, and there is some evidence that the increase in rents is basically flat in many areas and even negative in some areas. I haven't seen that negative component in all the apartment REITs earnings calls that I've been on and all the reports that I've read. The increases from year to year are fantastic. For tenants who are staying, they're still getting a rent increase, but when they leave and they can replace it with a new tenant, they can upgrade those rents to market rates right away. So I'm not seeing that data yet. But services are really carrying inflation. If you get some disinflation or outright deflation in the services sector, along with deflation in the goods sector, headline and core can melt away super fast. How do you get that? Recession. A recession will take care of that very quickly. This I find interesting here. New vehicles, 0, basically flat after a 0.4. You had a 0.7 falling to a 0.4 going to 0. And look at used vehicles. The used vehicles will follow along with what new vehicles are doing. So if new vehicle prices are moderating and going flat and maybe even decreasing in some sectors, used vehicles will. We'll talk about GM, Ford, and Tesla later on. Tesla's got a little bit of a problem with their new vehicles and the prices dropping on their new vehicles. But when we look at the used vehicle market for Teslas, it tells us why new vehicles aren't selling at the rapid pace that they are. Well, at least it gives us some insight into what's going on there. And it's a rather interesting story when you combine the stories from what is going on with what are called Tesla flippers, with the price decreases we're seeing in Tesla. But I expect there to be more downward pressure on used vehicles and on new vehicles, because a lot of the supply constraints are really starting to ease up now, so that production has been increasing. When we look at new vehicle sales month over month, we can see that they are increasing. They're up from where they were 6-7 months ago when you had supply shortage issues all over the place. That makes the story for GM and Ford not as compelling as it was 6 months ago when we said, listen, they can sell every single car they make. But when you have no wait lines, and you're dropping prices, and you actually are seeing some inventory starting to show up in different places, well, now they can't sell every car they make, can they? Okay, corporate yields. This is a curiosity. This is another outlier over here. If I have a recession story, so far, the long end of the curve, the 1 month rate, all of this, the move in the federal funds, all of it is consistent with that story. So I say, if my thesis is that there's going to be a recession, all the market moves are consistent with it, except corporate spreads. Look at that. They're flat across the board. And if we are expecting a recession, this makes no sense. Why would you have CCC or lower? Why would you have the spreads contract 20 basis points? You would have them widen. So I got a big fat question mark on the OAS. Last week I did show issuance. Issuance is way down. And if issuance is way down, and most corporate bonds, except the thin layer at the top of investment grade, most corporate bonds are buy and hold, especially in high yield. Some of them don't even trade all year long. That if there are funds that have to hold corporate bonds anyways, and you have a supply of corporate bonds that are decreasing, well, then it might make sense that you're not getting the change in spreads that you normally would. But this is rather curious, especially on high yield, which typically has a contract on the CDS. There's a fixed rate of 500 basis points sitting at 4.54. Seems rather rich. That they seem rather high priced. 5.99 was the high on the spread. That was in July. And even with the September sell-off, which saw Treasury yields hit new highs in September and October, spreads never went back there. The CCC did in September, 12.89. You had the BBB at 2.1 in October, but the high yield, AA still there, BB, all the way back to July. Mortgage rates. This has got to be good news for those looking for new homes. 6.31% coming in still, high of 7.08. It's down only 2 basis points over the week. But I want you to just absorb this for a second. In a week where the Federal Reserve raised the target rate by 50 basis points, the 30-year fixed rate mortgage came in by 2 basis points. I mean, 2 basis points doesn't seem like a lot, but when you put those 2 basis points contraction on the back of a 50 basis point expansion in the federal funds rate, that is something else, right? Mortgage applications, 2 weeks in a row. Look at that, up 3.2%. This is for the week ending December 9th. Refi index up 2.85. Purchase index up 4.05. Next week, we get a whole ton of information on the housing market, and we've known when we look at the housing market index, the NAHB housing market index, it has been in contraction for quite some time. That we are, when we think about recession, the way economists describe recession, it's a broad-based contraction in the economy. But you can have industries that are in recession, even if the economy is not in a recession, and housing Well, that's been in a recession for a while. But on the 19th, we get the housing market index. The 20th, you're getting building permits for November, a preliminary look. Later in the week, you get the final look. Housing starts for November, we get on the 20th as well. 21st, we get mortgage apps again up to December 16th for the week ending December 16th. Existing home sales for November. And the 23rd, we get new home sales for November. So building permits, housing starts. Building permits are a leading indicator. We'll look at that index shortly. Existing home sales, new home sales. Last week, S&P 500 was down 3.49%. Now, look at this. This is beautiful. D.R. Horton up 3.69%, Lennar up 3.6%, Pulte up 3.67%, Toll Brothers up 2.25%, KB Homes up 1.52%. DXY being the largest home builder in the U.S. For that kind of outperformance, look at this. SPY down 3.5%, DXY up roughly 3.7%, 7.2% outperformance. Look at the IV, the implied volatility for the at-the-money options on these: 34.9, 36, 34.6, 35.2, 43.2 versus 20 on the SPY. And before the November expiration, I said I think November would probably be the last good month to sell premium on the index. After that, you'd want to move from the index down to the individual names because there'll still be much higher volatility there. And here's where we are. I sold puts on DXY, Lennar, and Toll Brothers last week. I didn't touch KB Homes. I'm not too thrilled about that one. But I sold puts on those three because I do want to own them. But the premiums were nice, and I sold puts because on Thursday, they just motored ahead based on Lennar's earnings. They just motored ahead. But Friday they gave back, and when they gave back on Friday, I sold puts on them because they have really nice premium, and I'm moving away from selling premium on SPY to selling premium on individual names. These ones I'm selling puts on them. Things like IYR, which is a REIT index, I'm selling calls on. I didn't sell any calls last week. IYR really pulled back, so I took off some of my $90 calls. My REITs pulled back as well, but that's the point, right? The REITs that you hold drop down, and as IYR is dropping down, since I sold calls, they increased in value, which helped offset some of that. That's the hedge, rather than selling calls on each individual REIT, because some of these REITs have no options. Anyways, I think this is interesting activity down here, and it's nice when the market confirms what you've been thinking for quite some time, that home building, I think, is really going to be probably the outperforming sector to be in for the next 4 or 5 years, because we entered the rate hiking cycle with a structural deficit in housing. And in Canada too. In Canada, it's even worse as far as the deficit in housing, and it's going to get even worse because Canada is far more pro-immigration. But you have a structural shortage, higher interest rates, and if you listen to the conference calls from most of these home builders, almost all of them were saying, we're not building spec homes anymore. Spec homes meaning they'll build out a whole division even before it's being sold. They build it out on spec because the cost of capital was cheap to carry the inventory. Well, they're not doing that anymore, which exacerbates the supply shortage. So if in 3 or 4 quarters coming out of a recession, mortgage rates start really dropping because the Fed is dropping rates, that's going to increase the demand for housing that doesn't exist. So the margins that these home builders have been getting for the last few quarters, I think are going to persist for a while. Put a W there for winter. Okay, let's look at the jobs market here. Initial claims last week, 211. December 3rd was 231. We dropped to 211. Remember, I said to watch that number of 275K per week. 275K per week would be expected to print probably zero jobs month over month. 300K. If you're printing 300K week per week, you are definitely going to have some negative job growth month over month. job losses, not job growth, job losses, because it is a aggregate number, a total number, not a rate. So 231, 211, this is not showing that we're going to, so far, not showing that we're going to get a negative print. But PMIs are kind of telling a different story. I was also asked if I could comment on what the Philly Fed had put out. They're saying, the CES, which is the Census Employment Survey, is saying for the 3-month period, March to June, the economy created 1,047,000 jobs. And they have this early benchmark where they use the existing monthly census employment surveys that come out. That is this yellow line over here. They use that data to project what the revisions would possibly be, because every quarter, I shouldn't say every quarter, it comes out with a long lag, but there's also a quarterly census of employment and wages that come out that adjust the previous numbers that you saw. So it ends up having just better data, and the Philly Fed says, well, we have an early indicator for that because we have all the data that they use to adjust, so we're going to go ahead and do that ourselves. And they're saying, no, the economy only created 10,500 net jobs, not 1,047,000. So the number is wrong. Well, these are measurement devices that are imperfect. And we're not asking, when we look at these measurement devices, to ask whether it's precise, I don't think is the right question to ask. We want to know if it's consistent. So you can have an imprecise measure that is consistent, and it's the consistency that matters more because it tells us what the trend is. And we're going to see that the Census Bureau is consistent, but we don't know if they're precise. You could say, well, the Philly Fed says it's something different. The Philly Fed is consistent as well, but we don't know if they're precise. So when you're measuring something that is difficult to measure, precision is something that is not as important as consistency. So let me give you an example of consistency. Let's say I have a broken scale and it doesn't tell me my weight. But what it can tell me, if I have 10 people and they all get on the scale, I can rank those 10 people in terms of who weighs the most to who weighs the least. Even if I don't know their exact weight, the scale will still discriminate between who's heavier and who's lighter. So precision is less important in the number if I'm interested in the trend. And I think we're only interested in the trend. And I'll show you that they're consistent. If you go back to, and I've replicated the numbers here from the last quarterly survey. Here is the quarter ending December. Here's the quarter ending March, 2892. That's in here. Look at the 5.3. Then it drops to 1545. That's this period in here. Notice the 5.3 dropped to 4.4. Now they're forecasting 1,047,000 instead of 1,545,000, which is another drop. There's the 2.8 there. So you have consistency. Let's see if the Philly Fed is consistent as well. When it was 5.3, they said, no, it's actually 7% increase in employment on an annualized rate for that period of time, that the CES survey was underestimating what it was. Then it dropped from 5.3 to 4.4, and they dropped from 7 to 3.7. So they both went in the same direction, downward. Then this goes from 4.4 down to 2.8. They're going from 3.7 down to 0. So I don't know that the number is the important thing. The important thing here is the CES is showing this. The Philly Fed is showing this. They're both consistent. The trend is the important thing here. I wouldn't get too wrapped up in the precision of the number. That's not important. Now, these numbers up here for initial claims, when you look at the non-seasonally adjusted, that's an actual number because a claim is entered into a computer somewhere. So it's easy enough at the end of the week to say how many claims, initial claims, were entered in the computer. You get the exact number, 248,881. If it were an estimate, nobody estimates 248,881. They estimate something like this with zeros on the ends. Right? All these have zeros on the ends because all of these are estimates. You're not going to estimate 936,417. That would be stupid and ridiculous, right? But these are exact numbers. So we can look at initial claims and we can look at a history of initial claims and say, well, what story is initial claims telling us? And initial claims are telling us right now that the job market is still fairly robust, although it is slowing down, because if we look at those that are unemployed, we had November 19th, 1,609,000, 1,670,000, increased to 1,671,000. We're not going to get some really good numbers till January because you have a lot of Christmas hiring, right? You have warehouses that increase the amount of people they need. You have fulfillment centers that increase the amount of people they need. Malls and retail outlets increase the number of people they need. So you have all of this seasonal hiring that may be more or less than what other seasonal hirings are. So even though we're looking at the seasonally adjusted numbers, the fact is they're not on unemployment, or they're not getting unemployment. So if you look at the non-seasonally adjusted, see the drop? 1.5, 1,561,000 down to 1,505. So you have a significant drop because of this hiring. We're going to find out in January what happens and what happens with these numbers. But as far as this stuff goes, the employment surveys, these are all surveys, all imprecise measurements of something that is probably very difficult to measure. But when you have something, an instrument that is trying to measure something imprecise, you spend more time on determining whether or not it's consistent. Now, if it were inconsistent and imprecise, well, then it's garbage. But I don't see that it's being inconsistent here. That's the best comment I have on the Philly Fed, is that I don't know that the number matters as much as the trend, and both the Philly Fed and the Census Bureau have the exact same underlying trend, which is the trend we're seeing in the PMIs. So great, they all agree with each other. I'm not going to pick a fight on precision. Okay, let's look at retail sales. This came out on December 15th, the day after the Fed. By the way, if you look at the S&P, the SPX, let's look at the index, and you look at the closing on Monday night of the SPX versus the closing on Wednesday night. Now, in between that 48-hour span, you had CPI and you had a Fed meeting. And if you compare the closing price of the SPX on Monday night versus Wednesday night, 5-point difference. That if on Monday night I had somebody come to me and say, you know what would be a good trade? To do a 2-day strangle on sell the straddle on the SPX. I would have said, are you out of your mind? Sell the straddle? Sell the call and the put at the money? Are you out of your mind? We're moving. We're going somewhere. And then 48 hours later, I would have had to go apologize to that guy for calling him an idiot, because we only moved 5 points. It ended up being the right trade to do, but it would have been the stupidest trade I ever heard of on a Monday closing in front of a CPI report and a Fed meeting. But that's what we moved. That was it. And last week I said, I think that by the time you get to retail sales on Thursday, it's not going to matter. Turned out it was the thing that mattered. I was completely wrong on that one. Look at retail sales here. Negative 0.6 for the month of November. Nothing good in this report. Nothing good. Let's go down to Table 2. Table 2 tells a pretty ugly story here. Here's Table 2. And we're going to look at this first column over here. This is November 2022, advance from October of 2022. And negative. Look at all the negative numbers. Look at all the negative numbers. November retail sales from October, all of them down. What was up? Food and beverage stores. Because, well, if things are bad, focus on the beverage. That's alcohol. Up 0.8. Grocery stores up 0.8. Now, up 0.8 because have you been to a grocery store lately? Have you tried to buy a head of cauliflower? Have you seen the price of that thing? Health and personal care stores up 0.7. But look at this. Gasoline stations down. Clothing and clothing accessories down. Sporting goods, hobby, musical instruments down. General merchandise stores down. Department stores down 2.9. Non-store retailers down 0.9. Look at all these negative numbers. There's nothing good in this. Now, I want you to add this onto it, is that November had Black Friday, had Thanksgiving. All of that and this is what we have. All right, let's look at leading economic indicators here. Rather than looking at each leading indicator, we'll just look at the index here. And look at this drop straight down. This is the year-over-year change in blue, and the gray line is GDP. Straight down, the annual growth rate of the U.S. LEI became more negative in October. And then it gives you all of the different indexes that it tracks to make up the leading economic indicator, negative 3.2 here. This is interesting. The LEI diffusion index continues to show a strong recession signal. The red is a recession signal. The black is a recession warning. And look how consistent that is. It is showing a recession signal. And it is worth reading some of the comments here. Let's see where it is here for the leading indicator. Here it is. The U.S. LEI fell for an 8th consecutive month. Usually it is, if it falls for 6 consecutive months, it typically is a recession. That has been in front of every recession. This index falling 6 months has always ended in a recession. This is 8 months. Listen, look at the comma, and this next line is just like an arrow into your heart, right? If you're a bull, suggesting the economy is possibly in a recession. The downturn in the LEI reflects consumers' worsening outlook amid high inflation and rising interest rates, as well as declining prospects for housing, construction, and manufacturing. The Conference Board's forecasts real GDP growth will be 1.8% year over year in 2022, and a recession is likely to start around year end, meaning in a couple of weeks, and last through mid-2023. That when the dating committee comes back, the NBER dating committee comes back and says, when did the recession start? They'll probably pick December, maybe even November for the beginning of the recession. If you look at those retail sales, and those retail sales, those big numbers would be consistent with inflation coming down, because if nobody's buying stuff, nobody's bidding up the price of stuff. Leading indicators, that second part of that first sentence, suggesting the economy is possibly in a recession. Bang. And they're forecasting a recession end of this year to last to mid-2023, which is not going to be good for our earnings forecast on the index. We're going to have to start massaging down that number, and it has dropped a bit, but I think we're going to have to massage it a little bit more. Let's look at some PMIs. Okay, we'll look at the US, the UK, and the Eurozone. U.S. services, this is for December, 44.4. This is from S&P Global. 44.4. Anything under 50 for them is a contraction. Manufacturing, 46.2. The composite is 44.6. In their narrative for their report for the composite, fastest decline in business activity in more than 2.5 years, because the pandemic is in there. And they said if you remove the pandemic, it is the fastest decline in business activity since 2009. That's when the economy was falling apart. Remember, since 2009. New orders, fastest decrease since May 2020. Input prices, slowest growth since October 2020. Output prices, slowest growth in over 2 years. Employment had a small increase in employment, and they are seeing increasing layoffs. So employment, the new hires were significant, but layoffs brought it right back down to a small increase in employment. Let's look at UK. Services are 50, kind of in the middle line. Manufacturing, 44.7. The composite is 49. That's the 5th straight month of being below 50. New orders are down, but the drop in new orders is the slowest drop since September. So that is sort of, it's dropping, but it's kind of bottoming out. Employment is down. In other words, it's less than zero. It's not just that the growth in employment is down. The employment is down, less than zero, the most since February 2021. And this is interesting for manufacturing. Here's the words they use: a solid and accelerated fall in employment in manufacturing. Services were flat, which is consistent with the 50 over here. Input prices, substantial. So they're still seeing inflation in their input prices, but at a 19-month low. Even though it's still substantial, it's at a 19-month low. Output prices slowest growth since August of 2021. So what's going to happen here? You're going to have margin compression, wicked margin compression, because if your input prices are still substantial, but your output prices are showing the slowest growth since August of 21, it's got to hit your margins. Eurozone services 49.1, slightly in contraction. Manufacturing 47.8, composite 48.8, 6 consecutive months of being below 50, but it's the second month that it's been up. So it's been dropping and then it's up, and this is the second month it's up, but let's say there's the 50 line, still below 50. France is seeing a deepening downturn. Germany, the rate of decline is moderating. The December saw the smallest drop in 6 months. Still a drop, but the smallest in 6 months. So it's hitting that second derivative, the convexity, that the decreases are starting to slow down. Okay, DXY. What's going on with the U.S. dollar? Dropped 0.1% week over week. And again, in a week where interest rate differentials have increased, it dropped 0.1 week over week. These resistance lines, these are downward channels. What we're seeing is you had a drop in the DXY, but it's starting to do this now. So whenever you draw your lines down, they have to keep increasing like this. These are called speed lines. And you can see the speed lines are starting to slow down. This is technical jargon. You can't really read too much into this other than just observing that that's what's happening, because you're getting this drop in the DXY that's starting to do this kind of thing, right? So you might have a consolidation period forming where we might get some sideways movement as opposed to continued downside on the DXY. The froth on the DXY might have come up. We might be looking at some kind of sideways consolidation pattern. And I have heard some analysts saying that expect the DXY to spike one more time as the recession becomes a reality, and as we see that it's not going to be a mild recession, but probably a moderate to severe recession. Global money is going to find safe haven in the U.S. dollar, so you could experience another spike in the U.S. dollar back to the highs, or at least back to the 200-day moving average, which is sitting at right now 106.82. DXY is sitting at 104.7. It is below the 200. It is below the 50, and the 50 is heading down towards the 200 to what is called a death cross. Technically speaking, it is. A death cross is very bearish for the underlying, which is the DXY. The DXY did make a low of 103.77. You have 103.93, which is a support line from way back in the summer, from June to July, and did finish above that, but finished below the 105.11 and below the speed line, below the trend line, sitting at 104.7. Interest rate differentials didn't move the DXY, so I don't know that I would look to Fed policy at this point for direction on the DXY. I think, again, they're in the backseat. I think I would look at economic activity and global economic activity, and if it is a global recession that we're looking at that is going to be moderate to severe, money will find safety in the U.S. dollar. There will be another spike, so let's not kick the U.S. dollar out of the car yet. Let's not figure out what we're doing there. But it is going to be more economically dependent now and less monetary dependent. If we look at mining companies, all down over the last week. The ETF pick down 6.13%. Rio, Freeport, BHP, and the XME, which is the materials sector of the S&P, all of them down for the week. I'm selling puts on some of these as well. Look at the implied volatility, all over 30%, FCX 46%, BHP 32%, 38, almost 38%, versus 20.6% on SPY. And even though it's heightened implied volatility, if you look at the 13-week implied volatility percentile, 0, 2, 2, 0, 0. When it's 0, it's saying that 100% of all the implied volatility observations in the last 13 weeks were higher. That is really, really low implied volatility over the last 13 weeks. But still, better implied volatility than you're getting on SPY. 2023 at the bottom here, Goldman Sachs 2023 commodity outlook, an underinvested super cycle. We'll look at this report in a second. The link for it is in the description box below. It's a 20-page report, which is just a snapshot of their longer report. You're going to have to pay for the longer report. But there's enough in the synopsis, and I've highlighted a few points. The two interesting points that I see here is commodities. They say were shaped by the U.S. dollar in 2022. U.S. dollar was strong. Commodity prices were under pressure. They will be shaped by underinvestment in 2023, which means they'll be less driven by the level of the U.S. dollar and more in terms of shortage of supply. And I have made this case before, that with the move to electrification, when we're just looking at copper, for example, there just isn't enough being mined. When you get into the battery materials, they're going to hit a wall in a period of time. Zinc, I believe, is in short supply as well. Inventories are super low on zinc. And with EVs, aluminum, if you want those vehicles to travel further, you can't be using steel to make those vehicles. You're going to have to switch to something else. So I've read this, the 20-page report, and most of it is conclusions that I had already gotten to previously that are just repeated in their report. So it wasn't as if I was reading something going, oh, I never thought of that. It's like, well, yeah, I recognized that early. But let's have a look at what they're saying here. This is another sector, is the materials and mining sector, that I believe over the next 4 or 5 years, much like U.S. home builders and Canadian home builders, if you have access to that, I think are going to be winners. Okay, release date up here, December 14th, 11:53. I don't know if the 11:53 is important, but if you wanted to know when it was released on December 14th, that's the time. Just highlight some things. A year when underinvestment bites. Just as commodity markets have been dominated by the dollar in 2022, we expect them to be shaped by underinvestment in 2023. From a fundamental perspective, the setup for most commodities next year is more bullish than it has been at any point since we first highlighted the super cycle in October 2020. Despite broadly depleted working inventories and spare capacity nearly exhausted across most markets, capital in 2022 proved to be unresponsive to near record prices as market positioning remains skewed for a recession. Spot prices retraced to nearly to 2021 levels as financial deleveraging and physical destocking, both forms of short-run underinvestment, combined with the disorderly Chinese reopening to pressure energy prices since October. Across commodity markets, a rapid rise in the cost of capital lowers the incentive to hold either physical inventories or paper risk, distorting price discovery as financial markets react faster than the real economy, creating markets that are simply unprepared for sequential growth in 2023. There, I got a little bit of a point to make on this one here. Sequential growth in 2023. They're more bullish, I think, than most other analysts that I've listened to. They're not really expecting a moderate to severe recession in 2023. They're expecting sequential growth, but the retail sales, the PMIs, the leading economic indicator, the activity in the capital markets, the activity in the Fed funds futures, all sort of be pointing towards a recession. So sequential growth in 2023, I would say sequential growth Q3, possibly Q4 of 2023. Maybe they're counting the year as a whole and just saying, look, let's ignore Q1 and Q2 because it's going to be contractionary, but maybe Q4 will be the rebound. Okay, I'll go with that, but I'm not prepared for Q1 out of the gates to start showing sequential growth. Not that I could be wrong. I'm just not prepared to see that. No supply response in sight. While markets are divesting today, what's more startling is the lack of investment in commodities for tomorrow. Now, we've pointed this out before with the energy sector. Why would any energy company ever invest in any new capacity when every government and every car company in the world is saying we are going to obsolete you by the year 2035? Why would they do that? And when you have rising cost of capital, why would that encourage any investment in capacity? You're seeing that in the home builders. Rising cost of capital, they're saying, why would we build any supply unless it's already sold? Lack of investment in commodities for tomorrow. Importantly, the majority of the commodity deflation came from central bankers, raising the cost of capital and draining market liquidity, both physically and financially, which is not a long-term fundamental solution. Without sufficient capex to create spare supply capacity, commodities will remain stuck in a state of long-run shortages. They make a good point here. So what we're seeing is deflation in the goods sector. We're seeing deflation in the commodity sector because it's a lack of demand, but it's also, the other side of this is a lack of investment in new supply, that when demand comes back, you're right back to the same problem you had. So we could, based on this, you could see a period of inflation coming down, central banks lowering rates simply because we're in a global recession, then activity starts to come up again, and inflation shows up much faster in the next cycle, which means you'd have a perpetually higher level of the cost of capital. That's a tough place to be in equity markets, so you really have to, at that point, be a bottom-up stock picker. Where'd we leave off here? Yeah, remain stuck in a state of long-run shortages. Look at this last sentence. These underpin our expectation that commodities will return 43% in 2023. 43% in 2023. Well, I mean, that's an expectation. We don't know if that's going to happen, but the situation that they describe is the environment in which you could see 43% if you have growth. That's the big if. If you have a global recession, that 43%, that's off the table. This is all predicated on their sentence earlier, sequential growth in 2023. I don't know. I'm on the fence on that one. But will the new CapEx cycle take root in 2023? The key development to watch in 2023 is whether we will see a new CapEx cycle beginning to take root. How will we see that? Well, you listen to the conference calls for the miners. They report earnings, you listen to the conference calls, and you look at what their CapEx spending is going to be in relation to what their CapEx spending was in the past. And it goes on and on. Some nice charts, some good information here. I've been through it, but I just wanted to highlight it to you. I don't want to read the whole thing to you. In the description box below is a link to this report. Okay, let's move on to volatility. I've got two measures up here. We've got yield volatility, treasury yield volatility in the top over here, and down here we have the VIX index. Over the last week, this was Monday, December 12th over here, so this is volatility, treasury volatility. We can see really dropping down, the 2-year, the 5, the 10, and the 30 being at the bottom of this chart. This is supportive of taking on duration. And as more market participants see that yield volatility is dropping, they are more willing to hold treasuries, because that means price volatility is dropping. And if price volatility is dropping, well, then you have less volatility in your reported net asset value from quarter to quarter. So this is still very supportive of a duration trade. For the VIX, it is sitting at 22.46. Last week was 22.18. Not much of an increase considering that the S&P was down 3.5%, and went from last week pretty much at support, at resistance on the high side, all the way through down. Now it's sitting on support. A big drop like that with a lot of big events during the week and volatility, the VIX index could only squeeze out, 22.18 to 22.46. It is sitting, we are now sitting both below the 50-day and the 200-day moving average. We've been under there for some period of time. The 50-day moving average is below the 200-day moving average. That's called a death cross. That's typically bearish for the VIX, which could be either neutral to bullish for the SPX going into the end of the year. If we look at SPY, implied volatility 20.6, look at the IVP, the percentile 52, 26, and 13 week, 37th percentile, 28th, 20th percentile over here. This is rather interesting, is the term structure of volatility is in contango. It was in contango last week, looking like this, where VIX was down here, and there is the front month on the contract sitting above where the VIX happens to be. We're still above that. If you look at January, it's 24.65. It was 25.2. So over the course of the week, the front month dropped. But if we go out to June, we were at 26.65. It's now 26.7, which is just a little bit higher. So the curve has done this. The curve has steepened a little, with volatility inching up just ever so slightly at the longer end. So the spread between the front month, the January, and the June was 1.45 points. Spread between them. It is now 2.05 points if we're looking at measuring slope between 2 points, let's say. So it has gotten steeper, primarily because the front end of the curve is dropping more towards where VIX happens to be. I don't know what to read into that. That you have January futures price dropping on it, the expectation, and because there is these futures contracts are not no arbitrage pricing. So a forward price or a futures price on a commodity or on an index is a no arbitrage price. There should be no opportunity for arbitrage. Being that the VIX is an index of implied volatility, there's nothing there. There's only a measurement of implied volatility of some distribution, so there's nothing there. So the futures price is purely based on market expectations. You can read into that an expectation of the market, and they are expecting, based on the move in the VIX from 25.2 to 24.65 for the January futures contract, it is pricing in an expectation of lower volatility, which is consistent with lower treasury volatility. And it could be the case that, listen, you get a central bank that's expected to massively decelerate. They've gone 50, expecting 25 in February. If the leading indicator index is a good predictor of the recession, that we're probably either in one or going to be one for the first 2 quarters, that could be the end of rate hiking. That lower volatility will feed through to lower volatility in the equity markets. That, even though we look at 22.46 and say, well, that is very low volatility based on where we have been, if we look at a longer term chart of VIX, it's still very elevated volatility. So it could be that the market is still expecting a sell-off, but at a lower level of volatility than when you had high treasury volatility, which naturally would cause high equity volatility. So you could have a build-up volatility where, your equity volatility is a function of your treasury volatility plus some risk premium volatility associated with equities, much like you would have a build-up for, a bond yield where you start with a risk-free rate plus add a risky rate. Could be something like that. That could be consistent. But to look at the VIX and say, well, the market is expecting lower volatility going in January, that's typically bullish for stocks. I don't know that I'd be too eager to read in the bullish component based on the drop in volatility when the base volatility, which is treasury volatility, happens to be dropping at the same time. Okay, let's look at the TLT trade. Still looking at the January 24 long calls at 115. I already have those at 650. I'm looking to add some short puts on any significant pullback because I want to get cash neutral on my calls. TLT managed to gain week over week 0.73%. Again, while the S&P dropped 3.5%, it is up 0.73%. There has been a lot of conversation over the last little while about, is the 60-40 portfolio dead? You know, you have 60% equities, 40% bonds, and the idea was that when equities dropped, bonds would increase. But what we saw over the last year were both equities dropping and bonds dropping. Bonds are not a hedge against inflation. Bonds are the worst thing to hold for inflation, simply because they have a specified future payment, unless you have tips. Does that future payment, the future value, does not increase? You buy a bond for $1,000 a day. In 5 years, you get $1,000 back, and you have fixed coupons that don't increase with the rate of inflation. Again, unless you go with tips or with floating rate bonds. Bonds are not a hedge against inflation. Bonds are a hedge against bad economic outcomes. Bonds are a hedge against recessions. So is the 60-40 portfolio dead? Not if you expect a recession. If you expect a recession, your bond allocation will save you from your equity allocation. So I think that if you abandon the 60-40 portfolio, it's now time to revisit the 60-40 portfolio, because what's lying ahead is most likely recession, and a bond is a hedge against bad economic outcomes, which is a recession. Let's look at what we have for the chart setup here. For those who are more technically inclined, you have a downward trend that has been broken. We now have broken up above that downward trend, and you have a support resistance line at 109.20. I say support resistance because on the way down it provided support. Your downtrend provided resistance here on the move up. Then we broke through the support, which should now become resistance, and we see that it did try to retest the resistance zone here. You got yourself a double bottom, and you have a recovery from that double bottom, and notice we are now testing that resistance again. So 109.20 to the upside. We're sitting at 107.12. Technically speaking, 109.20 is a resistance line. The 200-day moving average is sitting at 113.16. So you're going to have to break this resistance line before you even test the 200-day moving average. The 50-day is down at 100.255, and we're sitting at 107.12. If we believe that inflation is coming down, there is no need for bond yields to go higher. If we believe that there's going to be a recession, there's no reason for bond yields to go higher. In fact, there's every reason for them to go lower. So at this point, I'm not seeing risk of yields to the upside. So that is why I want duration. Implied volatility on TLT sitting at 19.8, pretty much where the S&P is sitting at. Here's the implied volatility percentiles. 13-week percentile, 8%, rather low, which makes buying calls rather cheap. But I wouldn't be selling puts when I buy my calls. If you are going to buy calls, buy calls. Wait for there to be a pullback and implied volatility to increase, then you sell your puts, because you'll get them at a lower price and you'll get them at a higher implied volatility. Step into a risk reversal. Don't just do it on day one. Here's an interesting trade if you are in the recession camp and you want an interesting trade in your fixed income allocation. If you're thinking, well, 40% makes a lot of sense, I would barbell. I would be long a 1-year Treasury and long the 20-30 year, which is what you'll get in TLT. Long the 1 year because it's got 4.31% rate. No duration exposure there because it's a 1 year. Every day you hold it, its interest rate sensitivity keeps dropping, and you're getting a cash rate on this one, and here you're getting your duration. So if the central bank is going to raise rates another 25 basis points, the 1 year is not going to feel it that much because it has very low duration. You're going to get a 4.31% yield, which I don't think you're going to get in the first 6 months of the year on the S&P. And you're sitting in TLT that if we are entering a recession and rates drop, you got significant duration here. Up you go in pricing on this one. I think that is an interesting fixed income allocation, is to barbell, significant barbell. Not grabbing, the 2s or 3s and the 10s and 20s, but I mean, all the way to the 1, the very last security you can get in the money market, and all the way out on the capital market curve to the 20s to 30s. Okay, before we get to the SPY, let's have a look at General Motors, Ford, and Tesla here. Pretty bad week for all of them. GM was down 5.56% this week. Year to date, that puts them down 38.06%. Ford was down 8%. That puts them down 39.74% for the year. And for all the Tesla fans out there, Tesla was down 16% last week. That puts them down 57% for the year. The worst performing North American auto manufacturer. I think the worst performing global auto manufacturer for the year. Ford has raised its price on the F-150 EV. GM, National Highway Traffic and Safety Association, opened an investigation into Cruise because of some braking issues. You know, this Cruise, the valuation of Cruise wasn't in the price anyways. GM has this, I think, really exaggerated valuation for Cruise, thinking that robotaxis will be $50 billion in revenue by 2030. I don't think so. I don't, and I'm echoing some industry veterans here that also are very skeptical about the pace of full self-driving. Even Tesla still hasn't got it, and for all the Tesla fans out there who say, oh, well, it's just around the corner. No, it's not. I don't think you're going to have full self-driving until you have a significant majority of the cars on the road with full self-driving sensors, till you have the grid that has a bunch of sensors, and everybody's phone has something called pedestrian mode, so that the cars can sense them. And when every car can talk to the grid and talk to each other and identify moving targets in terms of the sensors that they have, then maybe you'll have it. But for the car to make all the decisions it has to make right now, I think this type of investigation into whoever's full self-driving is simply going to continue. I don't see it as a thing, but it wasn't in the price, but GM took a hit on it. So I did take that opportunity to add some GM at 36, and I added Ford at 12.19. I did not add any Tesla. To be fair, for Tesla, still most of the target prices are somewhere between 225 and 235 on the stock. Pre-split, that's about 675 to 700, a far cry from the 1200 plus on the price targets that we had seen before, but 675 to 700. They're sitting at 150.23 on their closing price. So most analysts are still seeing significant upside in the target price. But there are still some analysts who are seeing target prices of GM between the $70 and $80 range, which I'm kind of questioning now that supply channels are easing. I'm kind of questioning whether you have that much upside. For Q3, Tesla's gross margins were 25.08%. Q1, they were up around 32%, so that is a significant drop, and they are cutting their prices. They've cut their prices in China, they've cut their prices in Canada. And this may be because of the EV tax credit that is appearing. I think one of their cars, the Model Y, will qualify for it. And they've cut their price in Europe, and in some countries they do have inventory that if you order a vehicle, they have inventory on those vehicles now. Earlier in the year, I had put up a video about the ice age is far from over, and at the end I gave a very quick synopsis and sort of a forecast of where I think Tesla would end up based on the dynamics of competition that every company faces. No matter how great you are when you start, when competition comes in, it is just the structure of the economics of the industry that dictate what will happen. I said by year end of 2022, their margins will be somewhere around 24% gross margins, which, by the way, are absolutely healthy margins in this industry. Still industry leading margins, but you're not going to get to keep this 32% with everyone coming in. And I had a price target of 418 pre-split. Divide that by 3 is 139. And Q3 they reported 25.08% gross margins. I was thinking 24. They're sitting at 150. I said 139. I'm going to sort of declare a small victory on that one right now, because when I did put that up, I had a lot of Teslites laughing at me and calling me names. Boomer doesn't get it. It's going to be great to come back at year end and make fun of you and review this. This won't age well. Well, it aged well. How's that sound? It aged well for now. In about 6 months, they may be coming back for revenge, right? This is interesting. Third largest shareholder of Tesla has 22 million shares. It's an Indonesian, I forget the name, demanding Musk step down as CEO. Put it out on Twitter. Third largest shareholder wants him to step down as CEO. This is another interesting thing that I found. Tesla flippers. Ordered vehicles, took delivery, and are now trying to resell the vehicles. They are showing up en masse at dealer auctions, just trying to get rid of them. So that big back order of vehicles they had, a lot of the buyers in that were people who were, and dealers that were buying these vehicles and simply flipping them over to another buyer who was willing to pay $10,000 or $20,000 more for it, rather than waiting 6 to 8 months for delivery. Now that that backlog is cleared out and you can order some vehicles from Tesla and get delivery in as short as a week, 2 weeks, 2 months sometimes, all this inventory are starting to show up at dealer auctions, and that is pushing the price down, which is probably why Tesla is cutting prices on their vehicles, because their new car inventory is building, because they now have to compete with all those cars they sold, not to people who wanted to own the cars, but to people who wanted to take the cars and then flip them for more than what they paid for. So now you have a flood of these cars on the market. So that'll put some pressure on EV prices for a while, which is interesting that Ford decided to raise the price of its F-150 ahead of that, but it is significantly a different vehicle, right? It is a pickup truck. Tesla doesn't have a pickup truck. And I know, the pickup truck is right around the corner. Full self-driving is right around the corner. I know. The other issue with Tesla is Musk himself and this whole Twitter debacle. And his brand is losing cachet. So I think that you're going to probably see more of this kind of talk, that Musk is going to have to choose. What company are you actually running here? But overall, I've added to Ford and GM. I'm not adding to Tesla. These still have some good implied volatility, so selling the puts on Ford, selling the puts on GM makes sense. I added shares directly, but they have good premium in the puts as well. Okay, here we are, SPY. You see that little green line down here with the green shading up here? That means I am long some SPY. I added, my average price right now is 386, but I'm also long puts at 380 for April 2023 expiration, the regular expiration. That's not April the 23rd, that's April 2023. I've added some long puts. So I'm long the SPY at 386 with some long puts at 380. Forward EPS down to 224.15 from 224.70 something. It's not down by much. I think that has to come down quite a bit more. SPX closed at 38.52. Look at this. 38.37 is the bear market level. You close below 38.37.25. That is more than 20% off the high. They're back into bear market territory. On SPY, because it doesn't translate by just moving the decimal over, there are some rounding issues here. 382.08 is the bear market level on SPY. In extended hours, it ended at 382.50, but I think the close was 383.17. So it is sitting about $1.09 on the SPY above its bear market level. Here we're looking at, what, 15 points? 15 points to the downside. It has to be a close below that, not just an intraday entry into bear market level and up we go. But it has to close below that, because we did intraday on Friday get below the 382.08. So we did enter bear market territory, but it rallied at the end of the day to close above that that level. We are below the 200-day moving average and below the 50-day moving average. So on the upside, 18 times earnings is 401.56. We're sitting at 17.18 times earnings now if we accept 224. If we say, okay, let's accept the 224 as the forward 4 quarters, we're sitting at 17.18. 200-day moving average 401.92. Call it 400 to 402. Looks like it's going to be resistance. So if we are expecting a Santa Claus rally, which based on the closing on Friday and the drop in Treasury and VIX volatility on Friday, the VIX itself, maybe there is some thinking Friday going into the close to position for some rally into the end of the year, because there's really nothing of great importance between now and December 31st. Anybody who wanted to do any tax loss selling, I'm sure over the course of the year, has enough capital losses that they don't need to generate more capital losses. I don't know that, usually if you had a year that was very, very good and everyone's sitting with gains and you have some capital gains, usually you have tax loss harvesting at the end of the year. I don't know that we need to harvest any more losses. I think everyone's coming into the end of the year with some capital losses to carry forward to next year. If we get into bear market territory, 382.08, if we fail at the 50-day moving average, your next support level here is 371 roughly, followed by the market low on the closing basis of 357.40, on an intraday basis of 3,500. And there's growing chorus saying that, at some point we are going to revisit the lows. There seems to be a lot of belief that we are going to get back down to that level and retest. Going from 382 to 350, 320 points down is, another 9% down. I don't know that it would be as painful as the last time. I don't know that it would accelerate volatility to the same degree that it did last time. But as of right now, I don't anticipate that we would head to 3,500 in 2022. I know there's only 2 weeks left here, but I didn't feel it on Friday. The action on Friday didn't see, especially coming off that ugly Thursday, the action on Friday, while we were negative, didn't feel the same way. The alarm or the pace of the downtrend just wasn't there, and then you saw it in the last hour gain some strength and move up. That I felt that I think that most of the reaction is probably in Thursday's Wednesday, Thursday, Friday move. I don't know what to expect on Monday or what to expect for the last 2 weeks, but it wouldn't surprise me if we did get a rally. However, because the economy is now in the front seat and the Fed is in the back seat, I feel much more, secure in shorting the market at resistance levels, because I'm betting on the economy now. So I'm thinking 224.15 is probably too high, and 17 times is probably too high at this point. So if we did have a year-end rally, I think I would cheer that on. I would benefit from it because I don't really have too many short positions on the SPY right now. In fact, I had expiration on December on Friday. I think most of that is gone. I have a couple positions still holding, but overall my portfolio is net long at this point. I would love a rally back up to 400, retest that. At that point, I don't think that I would be selling any calls on the index at all. I think I would go right to the futures, and I would short the futures, and I'd probably use June futures. If you look at the futures curve, it is upward sloping. So if we're over here, you're shorting here. You have positive carry if you're shorting, negative carry if you're buying, but that gives you positive carry if you're shorting a futures curve that is in contango, and it is in contango right now. If you don't like the ES, if you still want to stick with SPY, but you just don't want any call risk on SPY, you can use XSP. XSP is not traded, it's just an index, and the index itself is 1/10 the SPX index, and SPY is 1/10. So XSP equals SPY. SPY is an ETF, so you have an underlying that is deliverable. There is no underlying for XSP, they are all cash settled, but what makes them attractive is they are European style options, not American style. European means last day exercise only, but there is no exercise because they're all cash settled. American means they can be exercised at any time. So if you are short calls that are in the money and there's a dividend coming up, you risk them being called away from you and you having to pay the dividend. American options, because they can be exercised anytime, that has value. It has value, so there'll be a lower premium on it. The European options, you get a higher premium, by about $1 on each strike, $1 higher premium. And you get pre-market availability. So they start trading before pre-market to 9:15, 8 to 9:15, or is it 8:30 to 9:15? I'm not quite sure. 9:15 they stop for the 15 minutes before the market open. Liquidity in the pre-market that I've seen is limited to at the money, and then the strikes very close to at the money. If you're going way out of the money, you got big spreads between the bid and ask, like $10 spreads. You're not getting anything done. But during the regular trading day, you got a little bit of a wider spread than you would with SPY, but higher premium than you would with SPY. And if you're selling in the money calls, because you think, if you think, well, if the index is at 382 and I think it's going to 350, let me sell a 350 call. On SPY, depending on where the dividend is, you have call risk. With SPX, there is no call risk because they're European. So you can go ahead and sell the 350 calls. You'll get a better premium than you would if you sold it on the SPY. You will have pre-market availability for it, although I don't know that you're going to get much liquidity in the pre-market on the 350 call, but it is there. So that's the play. If we have a rally into the end of the year, which I'm kind of hoping we do. I don't know that we will, but I'm kind of hoping we do. If we can get 100 points higher, 150, anywhere from, 39.50 to 4,000 on the index, I would be shorting the June ES contracts, or taking some position, a short position in the June ES. These are linear payoffs, not convex payoffs, right? That means if the market goes up, I lose in a linear fashion with the market. If the market goes down, I make money in a linear fashion, whereas options look like this. Options have convexity. These have no convexity. They are a linear function of the underlying price. If the market drops, I still would be willing to add to certain positions. I'd look for weakness in the home builders. I'd like to add more there. I'd look for weakness in the miners. I'd like to add more there. Ford and GM, if there's some weakness there, I'll add there. And I'll add selectively to my long position here because I got my 380 long puts protecting me on the downside. I'm still uncertain as to what the market wants to do, but I'm fairly certain that I think that we're going to be entering into a recession in the first half of 2023. I'm fairly certain that that forward EPS is going to come down, although I don't think we'll see it in earnings in Q1. I think they'll be okay, but I think that guidance is going to be the issue. But I think before we get to earnings, which we're about 4 weeks away from earnings starting, I think the economic data coming in over that period of time will confirm what the leading indicator index is saying, is that they are expecting a recession late in this year, which means it is late in the year. It's the 18th, right? How much later in the year do you want to get into the first half of 2023? I think, yeah, if you're not going to get a recession then, if everything we have is not going to tip the economy into a recession, then you might get, a sideways movement and a recovery from that. You might get that soft landing. That's not my base case. My base case is a recession, and probably a global recession. And we will end, as we always do, with our economic calendar for the week ahead. Having a look at Monday. I've already given you the schedule for the housing data, so we won't have to talk about that. Canada retail sales on Tuesday, forecast of 1.4% growth compared to what the U.S. saw. That's going to be interesting. I don't think so, but we'll see. There's building permits and housing starts. There's your mortgage applications. There's a big one for Canada. Pay attention to Wednesday. We get our November inflation rate, which will tell us what the Bank of Canada is most likely to do. The last Bank of Canada meeting, they indicated that maybe they're done. So we'll see what happens with inflation here. If it comes in light, they are done. That's going to be a negative for the Canadian dollar. But as I said last week, I've abandoned the active position. I got a hedge now, and that's all I care about. I've given up on the Canadian dollar on that respect. Consumer confidence, 10 o'clock. Not much for the rest of the day. On Thursday, you have GDP growth. It's our final look at third quarter GDP. We've had the preliminary, we've had the advance, and this is the final look. It doesn't change much from each time. I don't know that we're getting any new information going on here. Initial jobless claims, that's our new important thing that we're going to watch, is the jobs market. There's a big one. 10 o'clock is leading index month over month for November. It is forecast for another negative month over month. So forecast to drop yet again to a lower level. And we are already on recession watch. No, not recession watch. Recession watch. We're past recession warning. We're in recession watch on that one. Here's a big one for the U.S. You have PCE. I don't expect that PCE is going to disagree with the CPI. We already got some data for CPI, and every month PCE is consistent with CPI. Yeah, they're measuring the same thing in different ways, but they are consistent in that when CPI is lower than expected, PCE is generally lower than expected. I don't know that you're going to get a lot of surprise here, but if it comes in light, I'm pretty sure the market will see that as yet another data point and not just the same data point measured a different way and throw a party. If it comes in light, they might throw a party. Durable goods is in there month over month for November. Given what we've seen in retail sales month over month, we have a negative forecast here. That's probably accurate. Will the market pay attention to that? I don't know. You know, depending on what the PCE is, are they going to just overlook durable goods and say, yay, inflation is coming down, that's all that matters? Or, because I can't get a read on it now. Has the market in general moved beyond the Fed and now is focused on the economy? I put the Fed in the backseat. Have they put it in the backseat? If we look at Fed funds futures curve, it looks like they have put the Fed in the backseat and are now pricing in the Fed funds for a recession, not based on what Powell says. So it's like, yeah, you're saying that, but hang on a second. We're going to have a recession. That's what we're pricing in. I don't know. I don't know what the market is looking at or how they're thinking or what's going to happen into the end of the year. This is... so I have strategies for the upside and I have strategies for the downside, and I'm going to let the market tell me which one I'm going to play. Michigan consumer sentiment, 10 o'clock as well. We'll see where that is sitting. You got new home sales as well. So you could have a good Friday. PCE could come in light. Durable goods orders could surprise to the upside. Sentiment could improve, and going into the Friday, before the Christmas weekend, because it's the 23rd, right? Going to the Friday before the Christmas weekend, you could have a nice rally for Christmas, which really would set up the intermediate period between Christmas and New Year's as more of the same. It just follow through. There is a path to a rally to the end of the year. Let's see what happens. That is it. Okay, one more point before I go. I'm thinking of doing a live stream related to the market update and related to the applied series. As you can see on the screen here, I've done live streams for level 1, level 2, and level 3 for open Q&A sessions. But we do have quite a few subscribers to the applied series, and maybe some individuals who might be interested in it but want to ask questions or want to know more. I'm thinking of doing a live stream. I just don't know when, and I'm not too sure whether or not any of you actually care for that. It could be a live stream that's related to the market update. It could be a live stream related to the applied series, or general questions that you have. If this is something of interest, just leave a comment, and then if somebody's already left a comment saying, yeah, we would like that, just click on the like button under that comment to vote, and I'll judge based on what kind of response there is.